Hello there, welcome to this edition of Global Business Africa. In the next 30 minutes, we'll give you a usual fix of all the business content from right across Africa, from Nairobi, Johannesburg, Lagos and Cairo. We've got you covered. Here's what's coming up. Egyptians are calling for boycott of Turkish goods after the latter failed to recognize their current leaders. Over in East Africa, Kenya's jumped 4 places to Africa's economies rankings after rebasing its economy. And we'll be looking at 3 Nigerians who making it much easier to look and find for a job in Africa's biggest economy. Now, we'll be diving a little deeper into Kenya's GDP data a little later, but let's start in Egypt. Some citizens there are calling for an economic boycott of all Turkish products in direct response to that country's refusal to recognize the unrest that led to the ouster of the former president Mohamed Morsi. Now, both countries had summoned their respective ambassadors last year as relations between the two countries remain quite tense. The situation has been compounded now by President Recep Tayyip Erdogan's attack on his Egyptian counterpart in his speech at the UN General Assembly. Yasser Kim has the details on this growing diplomatic row.
Ties have been strained since July 2013, but Turkish President Tayyip Erdogan's latest speech at the UN in New York made matters worse. He launched a fierce attack on Egyptian President Abdel Fattah el-Sisi, who led the ouster of Erdogan's close ally and friend Mohamed Morsi from power after popular uprising last year. This prompted a strong-worded response from the foreign ministry, but also instigated an online and media campaign by Egyptians to boycott Turkey.
The best weapon now is the economy, and Turkey needs us. We are a major market for their products. Turkey is the #1 destination for Egyptians all year long. If all this stops, Turkey will seriously feel the effects.
Supporters of a boycott rely on figures that show Egypt is the largest importer of Turkish products in Africa at $5.5 billion. It's the highest number of Arab and African tourists in Turkey are Egyptians, while bilateral trade and investments had tripled in the last 5 years. Opposers of the boycott say these numbers prove that Egypt will stand to lose more.
Turkish companies employ 40,000 Egyptians. They will lose their jobs. We have many companies in trade and tourism that work with Turkey. They will close down if the boycott persists. We are still a weak economy to withstand such events.
What could be effective as well is the Row-Row agreement signed during Morsi's presidency in 2012. It gives Turkish products much easier and cheaper access to the Gulf and African markets through Egypt. Though the government has kept quiet, local media is reporting that Egypt is reviewing this agreement. If cancelled, it could cost billions of dollars in losses to the Turkish side. The Boycott Turkey campaign has just started. But if we judge from similar campaigns in the past against the United States, against France or Denmark, then we can safely say it won't work. It usually starts strong and dies out in a few months. Would it be any different this time? Yasser Hakim for CCTV, Cairo.
Now, if today's numbers are anything to go by, Kenya is among Africa's 10 largest economies after a rebasing exercise which revealed that the East African economy's output in 2013 was 25% larger than previously indicated. Kenya's GDP is now up to $55.2 billion. That's up from 44.1. That makes it the 9th largest economy on the continent. We'll get to those rankings a little later. But for the moment, it's enough to know that it's larger than Tunisia and Ghana's economy. Agriculture, manufacturing, real estate, all those contributed the most to the revisions. ICT is now being treated separately in order to account for the significant growth in the mobile money subsector, among many others. Now, the country also revised its economic growth in 2013 up to 5.7% from the initial figure of 4.7%.
That an increase in GDP per capita does not necessarily mean that Kenyans will be better off, nor does it imply that the existing socio-economic challenges have ceased to exist. Kenyans will be just as poor or just as wealthy as they were a year ago. All that the new GDP estimates tell us is that the economy is a lot worth more than we had thought. It tells us nothing about how that wealth is distributed.
While the results show that Kenya did in fact attain lower middle income country status in 2012, Kenya remains eligible for concessional financing from the bank's International Development Association, IDA, window.
Now, Kenya's move follows the more dramatic rebasing of Nigeria's economy that happened earlier this year in April. It vaulted that country's GDP to move it above South Africa to become Africa's biggest economy. Tanzania is also expected to announce its revised figures, as they're expected to forecast a change in GDP of about 20% from the current figure of about $32 billion. Now, in order of size, then, these are Africa's top 10 economies. Nigeria right at the top, as I mentioned earlier, $522 billion. That's the size of the GDP. South Africa comes next, followed by Egypt and Algeria. Angola heads the sub-$200 billion set, with Morocco close behind. Libya comes next. $70.3 billion is a relevant number there, followed by Sudan, Kenya, and another oil producer, Kenya. Let's dig deeper into the Kenyan numbers. Julian Mboko is an analyst with Nairobi-based StratLink Africa. He's with me in studio right now. Thank you for your time.
Thank you for having me, Robert.
In May, the Kenya National Bureau of Statistics forecast a 20% rise. Today, we're seeing numbers that essentially are way higher than that. What stood out for you in the revised data?
I think when I look at the numbers, there are two fundamental things. ICT is now a standalone sector by itself, and I think that was long overdue because Kenya has been growing by about 5% for about a decade now. ICT has been growing by anything between 15 and 18%, and therefore a year, yes. That by itself was really important. But on the flip side, if you look at the revised growth figures, Kenya has been on a steady path based on the prior to the rebased numbers of 4.4 in 2011, 4.6 in 2012, and 4.7 in 2013. If you now look at the revised figures, it has, after 2011, we had a dip from 6.1 to 4.5%. And that is important because for Kenya, it tells us we haven't yet weaned ourselves of vulnerabilities to electoral cycle shocks to the economy. And that will be very critical going forward.
Right. However, looking at real estate, because some of the numbers here, frankly, are absolutely shocking, like owner-occupied dwellings accounting for about 2% of GDP, and this was way back in May. But based on the revisions for 2009 alone, that went all the way up to about 8% of GDP.
Yes.
Why is such a huge portion of the real estate market off the radar from a statistics perspective?
I think in the spirit of just revising statistics, we have had massive data hiccups until this revision. If you look at Kenya National Bureau of Statistics, for instance, prior to the rebasing, if you asked for any data with regard to property in Nairobi, they would, in Kenya rather, they would give you statistics for Nairobi, Mombasa, and Kisumu.
And that was it.
And that was it. You wouldn't have Machakos, you wouldn't have Eldoret, you wouldn't have Nakuru, which are increasingly becoming satellites of growth within the economy. And therefore, from the real estate perspective, it has been largely a matter of data hiccups now being rectified.
And of course, the fact of the matter is, if you look at mortgage accounts as a proxy indicator, that doesn't really tell you much because it's a really tiny portion of the entire market as a whole.
Indeed, it's very tiny. I mean, when you look at the mortgage to GDP, it's about 3 to 4%, which is really, really small. But that could change going forward because we are witnessing a downtrend in commercial bank lending rates and also mortgage rates from about 19 2 years ago to about 16% right now, which easily would make the uptick, would beef up the uptick of mortgage by the markets in the economy.
Manufacturing as well. For quite a long time, a lot of people have argued that manufacturing in Kenya is in decline. Yesterday's news that Eveready is shutting down one of its production plants. It's been around for 47 years, essentially adding to that narrative. But today's data suggests manufacturing is actually bigger than we have thought before. Why?
I mean, if you look at manufacturing, there has been a shift which I believe has not been captured in the past years. Kenya's manufacturing policy, if you go down 20 years, has gradually shifted from import substitution industrialization to export-oriented.
Like textiles and so on.
Absolutely. To export-oriented industrialization. And that shift, I think, especially in the period of the 90s and the decade just between 2000 and 2010, was not sufficiently captured because there have been serious data issues and we haven't taken manufacturing as seriously as we should. But going forward, with the kind of market we are seeing in the East and Central Africa and the kind of expansion we are seeing by some of the companies within this market, it is vitally important that we now review the manner in which we regard manufacturing in this sector.
All right. Unfortunately, we'll have to leave it there, but that's all the time we have for this conversation. Thank you for your time this evening.
I really appreciate it.
We've been speaking to Julian Mboko. He's Julian S. Mboko on Twitter. In case you want to follow him, continue this conversation as well to dig deeper into the numbers. Focusing, of course, on Kenya's revised GDP data, 25% higher, according to the data coming out of KNBS earlier today. Let's take a quick break, a quick run through the markets here for you. Fairly mixed picture across the board. The Nigerian All-Share Index and the EGX 30 over in Egypt essentially closing higher by at least 20 or so, 0.2 or so. The JSE and the 20-share index in Nairobi, however, down in the red. There's plenty more coming up. We'll be looking at the African Hotel Investment Forum. There are 400 executives in Ethiopia. What are they up to? And there are tougher rules to curb the proliferation of conflict minerals being considered in the EU. Will be live in Brussels and in DC next. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast changing African business landscape. We take you where the business is happening.
The rebasing of Nigeria's GDP has been a long time in coming.
The information provides us much more scope to know what the structure of the economy is.
The most profitable 30 minutes of your day still continues. You're watching Global Business Africa. Now, seeking the means, the labor and the capital to expand Africa's hotel sector is smack in the middle of talks at this year's Africa Hotel Investment Forum. Over 400 executives are attending the event in the Ethiopian capital. Girom Chala is at the conference. He filed this report.
The African Hotel Investment Forum has brought together close to 1,000 hoteliers and players in the international hospitality business for a meeting whose goal is to create a better platform to encourage more investment in the hotel sector. And this means a lot for Africa.
Well, I think it's very important for the African continent because in addition to hoteliers, we're bringing together investors, we're bringing together financiers, developers, so people who are really interested in moving the tourism sector forward within Africa.
At the moment, sub-Saharan Africa suffers from shortage of hotels. Even the ones available rarely meet international standards. Hospitality experts say meetings like this one should provide solutions.
Forums like this help to expose, first of all, what those pitfalls are. And through discussions and forums like this, you are able to come up with solutions.
Over the past 10 years, investment in the hotel and hospitality sector in Africa has registered a tremendous growth. Even international hotel chains like the Courtyard Marriott in Wyndham have started investments in Africa. Wyndham, which is the largest hotel group in the world, for instance, signed a multi-million-dollar deal with an Ethiopian company to open one of its hotels in Addis Ababa.
Addis Ababa is becoming a hub within Africa. So this step one in growing the economy and the tourism for a country is being achieved. The second step is obviously the infrastructure. And if you look around you and if you just go have a tour around, you see the major works for highways, intersections. So the means of communication within the city and within connecting the various cities is becoming more and more reliable and easy.
Throughout Africa, a growing middle class, sustained economic growth and recent discoveries of natural resources across the continent are driving the demand for quality hotels. The African hotel sector needs more bolder and stronger investments in the coming at least 10 to 20 years for the continent to make the best out of the tourism sector. That is what economists suggest. It looks like things are coming together momentarily. Sustainability, however, remains a grave concern for now. Grumtala, CCTV, Addis Ababa, Ethiopia.
South Africa's Trade and Industry Ministry has announced a $10 million loan facility for small and medium-sized jewellery makers. Working capital loans provided under this scheme have a fixed interest rate of 3% per year. They were sourced from a fund managed by the Industrial Development Corporation. Angelo Coppola has more from Johannesburg.
Over the last couple of years, manufacturers have increasingly tied up more and more of their capital as the gold price increased and as local currency decreased in value. The price of gold in US dollars was at times 3 and 4 times more than it was in 2004.
We're offering a loan on easy terms, basically at a rate of interest well below the prime rate for the acquisition of gold. This facility is available to manufacturers of jewellery products.
The loan facility is directed at small business owners who generally struggle with capital management.
It's always a problem, especially with us small businesses, unlike your big companies. So we really appreciate what the minister they are doing for us as small businessmen in South Africa.
There are several sectors in the country that haven't fully developed their value chains, with the country losing out on much needed foreign currency.
Italy earns much more from the jewellery manufacturing than South Africa does from the production of gold. In fact, we need to move into value-added activities.
It appears that the minister's approach has been well received. Players in the sector believe that they can also play a role.
To involve more of the small business people, but who has the knowledge and the skills of beneficiating diamonds in South Africa, refining your gold.
This is another drive by the Department of Trade and Industry to ensure that the small business sector gets up on its feet and doesn't have its capital tied up. We will watch this sector closely to see if it actually works. I'm Angelo Coppola for CCTV in Sandton, Johannesburg.
Elsewhere on the continent, critics are calling on European policymakers to impose tougher rules on the import and the use of conflict minerals, much like the US did with Section 1502 of the Dodd-Frank Act, as it's more commonly known. Amnesty International's Director for Global Issues, Audrey Goran, says there are reasons to believe European companies are profiting from using minerals sourced from mines in areas controlled by armed groups in countries like the Congo and Colombia. Goran added that the EU needs to come up with a law that effectively breaks the link between European trade and violent human rights abuses overseas. In March this year, the European Commission announced a proposal to set up an EU system of self-certification for importers of specific commodities: tin, tantalum, tungsten and gold, all of which might originate from conflict-affected areas. Let's expand this conversation and drag in Jack Barton, who's at the EU Commission's headquarters in Brussels. Daniel Rangers joins us once again from Washington, D.C. He was, of course, on Africa Live in the last hour. Gentlemen, thank you for your time. Let's start with you, Jack. The EU's approach has a strong emphasis, on voluntary compliance, not the mandatory compliance that Section 1502 of Dodd-Frank has. Why was this approach taken?
Well, with the Dodd-Frank Act, that's a piece of legislation crafted by a single federal government in a single country, whereas, of course, the European Union, whenever they have to go through this legislative process, and this is, of course, still draft legislation, it has to get consultation and agreement from all 28 member states, and that is a lengthy and difficult process. So what we've ended up with is this legislation that is certainly, some would say, weaker than the Dodd-Frank Act in this regard. Companies, and there are many here in Europe, around about 400 European companies import the 4 commodities that you mentioned before: tantalum, tin, tungsten and gold. They account for about 35% of all of the global imports for those commodities. They're to be put on a database that will be set up, and the companies will have to self-monitor. But that self-monitoring will have to be very clear. They will have to be very transparent. And if there are sudden inspections by the EU, they will have to fully disclose where those commodities have come from. However, if they do, and it does show that they've come from a country with conflict, and at the moment there are none on the list, unlike Dodd-Frank, which singles out the Congo and surrounding countries, there are actually no countries on this draft legislation. But if it is felt that they do come from a country, that their origins are in conflict, then those companies will be taken off the list. But they won't be fined, there won't be be any sanctions for breaking those rules.
Indeed. Daniel, June the 2nd was the deadline for the initial filing of reports to the SEC on whether or not inputs were sourced from conflict countries by American companies. What trends have emerged from the over 1,000 filings made so far?
Yeah, 1,300 filings, and at least 80% of them have basically said they're not sure if they are sourcing conflict diamonds, but there are requirements to look at the global supply chain, make detailed analysis of that global supply chain, detail the companies and the mines and the smelters and all the rest of it, and put that in a Securities and Exchange Commission filing, and also publish the information on a website. Some of the companies, only about 5 or so, have actually said that they have carried out an external audit, a really thorough audit. Intel is among these, and Intel is also leading, along with Motorola Solutions, and a way in which the global supply chain can be analysed and audited within the industry itself. And the interesting fact about the Dodd-Frank Act is that it does not make illegal the supply of conflict minerals. What it does, though, is make the process a lot more transparent. And it's clear from the initial findings of these reports that were made in early June that many of the companies still are struggling to get a sense of their supply chain, and 55% of them are promising to do a lot more in the future. So this is not the end of the road for this process, it's still going on.
Indeed. Jack, briefly, does the proposed plan cover only EU-based importers of raw materials, or does it also put pressure on companies with manufacturing bases in China to undertake similar supply chain due diligence?
Well, it only covers EU-based importers, but they have to completely monitor their supply chains, no matter where it's coming from. So it's not just who they bought it from at the last port of call, but where they got it from, who transported it to them, where it was dug out of the ground, and by who. And for tantalum, for instance, about 80% of the EU's tantalum comes from China. 17% of that is thought to be sourced from the Congo, which is on that Dodd-Frank list. Then there's Kazakhstan, which only 5% of the tantalum comes from Kazakhstan, but 25% of that comes from the Congo. So companies are going to have to document this, but again, there are no countries listed on the EU draft legislation, so at the moment it's very vague, and also it's not quite clear how long the companies are going to have to comply with this, or how long it's going to take to set up this sort of self-monitoring process. So really at the moment it's very unclear just how effective this new piece of legislation is going to be.
Indeed. Gentlemen, thank you very much for your time. Jack Barton there live in Brussels, Belgium, and of course Daniel Ranges live in Washington, D.C. Quick run through commodity prices here for you. Some interesting developments with regards to cocoa from one of its main suppliers, Cote d'Ivoire. Right in West Africa, concerns of course about potential supply disruptions that might emerge if by any chance the Ebola virus does show up over there, and that's of course putting a bit of pressure, upward pressure that is, on cocoa prices moving forward. Coming up, we're back in West Africa. We'll be talking to 3 Nigerians who've made a job search a lot easier in the country. They're making quite a bit of money out of it. The details are coming up next. Welcome back. Between 2005 and 2010, the number of jobs available in Nigeria grew by about 3.4% per year. That's barely enough to attain double-digit employment in that country. Now, to make the search for talent more efficient, 3 young Nigerian entrepreneurs created an online job search company. Jobberman, as it's called, was launched in 2009, and it's helping thousands of job seekers across the continent find work. CCTV's Noel Makurugu has more on Grassroots.
Ayodeji Adewumi is a co-founder of Jobberman, an online job placement site in Lagos, Nigeria that is fast becoming one of Africa's biggest job sites. What first began as a hobby for 3 students has now become a large company that employs more than 125 people and is estimated to have a multi-million-dollar valuation. Launched in 2009 by Adewomi and his 2 friends Olalaken Olude and Opayemi Awoyemi, the startup has gone to help more than 35,000 people in Nigeria and Africa to find work in the last 2 years.
A client sends in the job, they post the job online, they have access to their account. They sign into their account and click on post the job. When they click on post the job, it comes here and we need to approve. And before we approve, we call the client to get more details from the client on the job. We help them write a proper job description to get the right kind of candidate, and we type that in here under the job descriptions. Then some of them have some key areas they want the applicants to have, some qualifications. We fill it under here, and the years of experience.
Despite being Africa's biggest economy, where oil wealth has enriched the elite and grown the economy, finding a job in Nigeria is a big challenge. But with increased number of youth having access to the internet, finding work is becoming a lot easier. According to Jobaman, the number of companies using the site to find employees has grown from 40 when it started to around 35,000 today.
We've been able to uniquely get jobs, right, that have been targeted to Jobaman subscribers, for example, and we've had a tremendous growth in in people being called for interviews and getting jobs on the portal. So in that way, we've had our own share, I must say, of value to the unemployment market and the employment market.
Job seekers say they are happy that they do not have to go through the usual job search hassles.
I got that the options. I had a whole lot of options to apply. As in, I submitted my application for this one, and I got called up for interview, and I thought it was a huge impact in my life.
However, the company has faced challenges along the way.
The most compelling challenge will still be just trying to convince people, trying to educate them on an ongoing basis, because it's pretty much a change in behavior. People that typically will go to an headhunter or go to a recruiting agency to be able to place their candidates or go to the newspaper to advertise their jobs, and now we're now saying to them that they should come to us because we give them the best chance of placing those candidates or the best chance of finding a job. So definitely it's a major challenge.
Critics say that although Jobaman is offering solutions to unemployment, a lot still needs to be done in helping people find jobs. Noel Makugu, CCTV.
Right then, a quick run through the currencies here for you. The broad underlying narrative we have to keep in mind when you're looking at these numbers is the underlying strength and the rising strength of that of the American dollar. That said, worth keeping a close eye on Egypt. The government there says it is fairly intent on clearing up most of the debt that it has acquired with regard to oil supplies. It's going to be borrowing a bit of money from banks in order to lay off some of the $6 billion or so that it owes a little later on from the 8th of October. Quick run through what we're working on for you tomorrow. Let's start in South Africa. The Transnet BHP Billiton, they're in a 10-year coal export deal for coal export on rails. We'll have the details on that. We'll also be in Egypt. We'll be looking at Africa's most innovative stock exchanges, given the latest rankings that apparently put Egypt right at the top. That's it for this edition of Global Business Africa. Thank you so much for watching. As usual, you know the drill. Feedback, globalbusinessafrica@cctv.com. And of course, at the end of the day, wherever you are online, Facebook, Twitter, you name it, the news continues right over there. I'm Raman Yang. See you in 23 hours. Thank you.